Budget 2015 was the first full budget of the Modi government. Several policy announcements have been made. Some of the key announcements for the financial sector talk about the introduction of a new India Financial Code, a bankruptcy code, as well as with respect to foreign investment coming in. Foreign investment in AIFs are now to be permitted, as well as for the banking industry, the caps between FII and FDI are proposed to be done away with. With respect to certain specific tax proposals, the GST, a big news item everyone waiting for, is supposed to go live effective April 1, 2016. DTC, which was to overhaul the current Income Tax Act, is to be now dropped. If we now move to some of the bigger items which were announced for the financial services sector for tax, GAR deferral, again something which was expected by the industry, has now been put on the block in terms of deferral by 2 years. The silver lining on the GAR proposal was that all investments up to 31st March 2017 will be grandfathered. Indirect transfer provisions, welcome definitions have been introduced. The term substantial has been defined to mean 50% or more of the Indian assets. Proportionate taxation of gains only to be done, as well as small value exemptions have been brought in. The FPIs were looking for a complete exemption from the indirect transfer provisions. However, that has not come through. This would raise concerns, especially for two-tiered structures, as well as potentially access product structures. MAT on FPI. Recently, there were audit proceedings being conducted for applying MAT to FPIs. The bill does deal with this. There is a proposal to exempt gains on transactions in securities to FPIs. However, there is no specific overall exemption for FPIs. Again, this raises concerns. Interest, for instance, which is earned by FPIs, which is subject to tax at a concessional rate under domestic law itself at 5%, if subject to the MAT provisions, will now be taxable at 18.5%. Similarly, FPIs coming in from treaty countries may be made applicable to MAT. Debt FIIs could stand to lose if this is made so to happen, as short-term capital gains on government securities and corporate bonds would then be made subject to the provisions of MAT. Another key provision is to do with the AIF taxation. Pass-through has been provided, a welcome step, with all Category 1 and Category 2 AIFs. However, there has been a carve-out in terms of a separate basket has been created for capital gains, interest and dividend, whereas business profits has been put at the fund level for taxation. For AIFs, there has been a pass-through which has been provided for capital gains, interest and dividends. However, with respect to business profits, taxation will still reside at the fund level. This can create issues from a characterization perspective. With respect to the flow-through on the pass-through side, a 10% TDS has been set in place. This will be a huge negative for companies which are loss-making investors, for entities such as insurance companies which are having low ATRs, as well as for exempt entities. Even investors coming in from Singapore, Mauritius and other jurisdictions could be subject to this 10% withholding, which will then have to be reclaimed by way of filing a return. The other provision with respect to the AIFs is with respect to losses. Losses will stand trapped at the fund level and will not be passed on to the LPs. Terminal losses, as a result, will be trapped in the AIFs to perpetuity, and this can create issues for the LPs. Onshore fund management. Again, the industry was looking for a tax regime which would provide safe harbor for onshore fund management. The finance minister has heard through that. An offshore fund will not be subject to taxation in India, basis residency or business connection with respect to the fund management that gets carried out in India. Positive development, however, several onerous conditions have been made with respect to the fund qualifying for these benefits as well as for the fund manager. With respect to the banking sector, one provision which has been introduced is to basically say that any income, any interest income which is earned by the head office or an overseas branch from the Indian branch will be deemed to be taxable in India. This is to set aside the special bench ruling in the Sumitomo Bank's case. With respect to GDRs, there is a mention in the budget again. The new GDR scheme has been introduced in 2014. However, tax certainty has only been provided with respect to depository receipts which have the underlying as listed securities. So from an overall standpoint, one can see that the finance minister did have the courage to take on several provisions that the industry has been asking for, but the fine print does cause concerns. Hopefully, these will be resolved in the days to come. Thank you.